It's a great time to go into a fixed coupon rate kind of a product. It makes a lot of sense to put into debt mutual funds right now when compared to fixed deposits. PPF being a tax-free instrument at 7.1% is a very, very superior product when compared to even an 8% fixed deposit.
Hi everyone, welcome to another episode of TOI Wallet Talks. Fixed deposit rates have been rising steadily, and fixed income instruments are actually the go-to destination for risk-averse investors. So, to understand better the options available within that, we have with us Harshvardhan Roongta. He is the CFP of Roongta Securities. Hi, sir. Welcome to the show.
Thank you, Smriti. I'm glad I'm chatting with you on this important topic, which is about debt investing right now.
Right, sir. So my first question to you is that, for the very first time, the fixed deposit rates in several years are actually beating inflation. So given the current uncertainty in equities, should this be my go-to investment destination?
Well, Smriti, whenever we talk to any investor regarding creating a portfolio, there's one element which is very important, and that is asset allocation. So irrespective of what the market conditions are, so there is one situation which we're talking about right now is equity markets being volatile. Should you invest into debt? Well, I'll just take one step behind, and I will ask investors to probably look into their asset allocation plan. Right. So in case, for example, they had a 60-40, 60% going into equity and 40% going to debt, that allocation does not change only because of market being volatile and interest rates being high.
Right.
So if you're sticking to that 60-40, yes, it's a good time to change within the debt allocation where you were investing earlier. Probably you can change that, but not the allocation primarily based on the market condition.
Okay. But if I am a fixed deposit investor, then should I be parking in more money here?
Yes. Now, see, that's the element that I was talking about, that in case you are within the debt category. So you're already investing into debt, you were investing into certain products. It could be a short-term debt fund, or it could be a liquid fund, for example. Right. And now the question arises that interest rates are like almost 8% and above. Okay, so can I shift from a liquid fund, or should I shift from one debt product into a fixed deposit? Yes. So for all those investors who do not understand the nuances of how a debt fund functions, like there is a capital gains element to it, or there is a capital loss element to this. NAV fluctuates with the movement of interest rate. In case you're not well versed with that nuances, then this is a great time to go into a fixed coupon rate kind of a product. Now, if you're investing in a fixed deposit, which is giving you an 8% interest, at the beginning of your deposit itself that you're going to earn an 8% interest. There is no ifs and buts about it. So yes, given that interest rates are at a decent peak, I would say, I think if anybody wishes to lock in at this point to say that, okay, I want this fixed for next period of time, fixed deposits work best at this point in time.
And what about fixed deposits or fixed income deposits with small banking financial institutions, or even corporate fixed deposits?
So, well, Smriti, when it comes to debt, okay, overall as debt, forget fixed deposits in isolation and let's talk about debt.
Right.
Why do you put money into debt? The idea primarily is capital protection. There should be liquidity and there should be safety. I mean, essentially, these are the elements that we're talking about when you're putting money into debt. For everything else, there is equity. Now, when you're putting into debt, and if you find an area which is slightly, I would say, a possibility of some kind of, capital loss, I mean, would you want to then park your money into that? So I'm coming to a point saying, if you're investing into debt with the primary objective being capital protection, nominal returns that you earn, liquidity, and don't want any kind of risk whatsoever, then I wouldn't personally suggest a small finance bank kind of a thing. I wouldn't suggest anything of that sort.
Right.
When it comes to corporate FDs, you have a lot of corporates who are AAA rated. So yes, you can most certainly take the advantage of corporate deposits, provided the credit rating is at least a AA plus or a AAA. So if it's a AA plus or a AAA, like for example, you would have HDFC Limited, you would have Bajaj Finance, you would have Mahindra Finance, you would have PNB Housing Finance. So if these are the kind of corporates you're looking at parking your money with very credit ratings being very high, then it's fine. But small finance banks and all, I wouldn't personally recommend putting money over there.
Okay. And would you recommend fixed income mutual funds?
So in fact, I just mentioned a couple of minutes ago saying that if you're not well, versed with the functioning of a mutual fund, then you can shift to debt, to fixed deposits rather, which have a fixed interest rate. However, Smriti, this is a great time to be into debt mutual funds. I'll tell you why. There are two places where you're likely to make money. One is, of course, the interest, the coupon payments that the fund will receive. So if you're investing in a debt fund, the fund will earn through the coupon payments that they've invested into, the bonds that they've bought into. The second element, we are almost, I would say, we may not be at the peak of the interest rate cycle, but we are almost at the peak of the interest rate cycle. So what happens when interest rates start falling? If interest rates starts coming down, then this debt mutual funds will also make capital gains. So one is a coupon payment that they are earning, and the second is capital gains. And as I said, we may not be at the peak of the interest rate cycle, but we are almost there. So I think this is a great time to invest in debt funds. And especially, I think, a short-term to medium-term debt fund category, if you're putting your money into that, over a period of next 2 to 3 years, there's going to be, my sense is that you'll earn you'll earn a return which is much higher than a fixed deposit because of the capital gains element that I'm talking about. Besides, from a taxation standpoint, if you're invested for more than 3 years into a debt fund, the tax that you pay on the income that you earn is going to be much lesser than the tax that you pay as interest on the interest that you receive. So while a debt mutual fund over 3 years is taxed at 20% with indexation benefit, the interest that you earn on a fixed deposit is added into your income and you pay tax as per your tax plan. So if I put these things together, it makes a lot of sense to put into debt mutual funds right now when compared to fixed deposits. However, if there's an investor who does not understand the fluctuations of NAV with the movement in interest rates, then I think a fixed deposit is a decent product where you don't have to worry about what's happening. You know that you're going to get an 7.5% or 8% interest. So I think that is good with both different profiles of investors.
Okay, and what about for within the category of risk-averse investors? Is it better to invest in FDs or PPF?
Also, PPF, there are pros and cons. The pros being, of course, that it is a tax-free interest income that you earn. So 7.1% is the interest that you're earning, and there is no tax whatsoever. Now, if you compare it to a fixed deposit, the only downside would be that it has a 15-year tenure. Well, a fixed deposit could be even 1 year, 2 years. It could be 5 years. It could be X number of years at the discretion of the investor.
Right.
Wherein in PPF, the tenure is 15 years. Though you have withdrawal options, but they're very restricted, and that is only after 3 years of deposit, etc. So purely speaking, both cannot be compared. But a PPF being a tax-free instrument at 7.1% is a very, very superior product when compared to even an 8% fixed deposit. Because after tax, post-tax, the fixed deposit returns will be much, much lower than a PPF.
So basically, you're saying that it is entirely dependent on how long you want to lock in your money there. If you have a long-term investment avenue, then PPF is a good option, also because there are tax benefits there.
Absolutely right. So in case you have a horizon of 15 years, if I may put it like that, though an average, so you may have started a PPF 5 years ago, so your residual period is only 10 years now.
Right.
Because the PPF will mature in the next 10 years. So if I'm not getting into those number of years residual from maturity, if you have the potential to park your money and stay invested, okay, you don't have the liquidity requirement in the short term, then PPF is far more superior. For a couple of reasons, of course. The interest being tax-free, there is tax benefits that you get. It cannot be attached against any other degree that you have. So it's a very personalized, that secured kind of an investment option that you have. And if you have a requirement for short term, you need money in 1 or 2 years, then PPF cannot be used as a product. You need to put money into a fixed deposit.
Okay, and what about post office savings schemes in NSC?
So post office savings scheme, of course, is a very good option. However, if you see the interest rates that are now being offered, earlier there was a situation which was the reverse way. You would have post office giving you higher returns than what a bank deposit was giving you. But they seem to have, the banks have started moving a little faster in terms of revising the interest rates. Wherein in most cases you will see the interest offered by bank is higher than post office right now. Nevertheless, I mean, if you look at a post office monthly income scheme, which is at 7.1%, so it gives you interest monthly. Wherein you'll have another option from a corporate probably who gives you a monthly interest at 7.25 or 7.35%, and both being taxable. So at this juncture, I would think there are, outside the post office or the small savings realm, there are a couple of deposits which give you returns more than post office deposits, small saving deposits. Senior citizen savings scheme, of course, is not a comparable because it gives you 8% and that is paid out quarterly. So I think that is a far more superior investment for all those who are 60 years and above. Yes, the limit over there has now gone to 30 lakhs, which will be from effective 1st April.
Right.
You'll have the limit enhanced to 30 lakhs. I think it's a beautiful product for all those who are 60 years and above and who do not want to get into the fluctuations of NAV based on interest rate movements in debt funds. So for them, Post Office Senior Citizen Savings Scheme is one of the most superior products in that case.
So you were talking about tax planning and March 31st is approaching. So from a last minute tax planning perspective, are there any fixed income instruments that you recommend?
Well, Smriti, if you're standing at that point wherein you're looking to invest to only save tax, and this could be a one year exercise, you do not want to take any commitment on that. So in case you already have a PPF account, then of course you'll just go ahead and invest in it. If you don't have a PPF account and you plan to open a PPF account, just remember that it's a 15-year deposit and you'll have to keep investing every year at least a minimum amount. So you don't do that if it's only for a single year that you're looking at. There are bank deposits, the 5-year bank deposits, which are eligible for tax benefits under Section 80C. So yes, most certainly for anybody looking at single installment, single payment for only this year, then a bank deposit makes most sense.